Hello everyone, I'm Roy. Welcome to the another episode of Market Update. We left behind a weekend of high geopolitical tensions. Just to summarize, Iran has initiated significant escalation by launching hundreds of suicide drones towards Israel as a response to an Israeli strike earlier this month on a building in the Iranian embassy complex in Syria. And this action heightened the security measures in the region, with Iraq placing its military on high alert and closing its airspace, and Iran suspended commercial flights. Then also in all the region, the commercial flights cancelled. And meanwhile, Israel War Cabinet has convened in Tel Aviv to address the situation, and Biden monitored the developments from the White House Situation Room, and U.S. pledged their support for Israel's defense. And just afterwards, Iran said, okay, this was kind of a warning for Israel, and that's why things got better after a point. But the Saturday, with the rising concern, the Bitcoin fell almost 10%, just less than 30 minutes after the news, and crypto markets erased nearly 200 billion USD in market cap. It was just in a less than 30 minutes. I was on the screen and the chart was pump. Futures opened positive with the beginning of the week and trading around a 1% higher than the previous close. So gold's uptrend is still intact. VIX index futures trading around 16-17 range. And today I'll be first talking about the details of recent US CPI data. Then, while we're going through and kind of in a geopolitical risk environment, I would like to touch to the factors affecting the bond yields, as they're the indicators of risk on risk of sentiment. And I'll try to explain what the yield curve indicates about the market. Let's start. So US CPI data, both in headline and core numbers, exceeded the market expectations. Were exceeded with 0.4% in the monthly data for the headline, and 3.5% for the headline year over year, and 3.8% annually for the core side. So persistent inflation data is still jeopardizing the possibility of soft landing scenario. If the expected improvement in the inflation is waiting to some disruption to happen in growth and labor side, it will be risky for the indices for sure. In that scenario, just gold, precious metal would be still strong. And when you check the details of the from the details of the data from the BLS goal, the rising gasoline and shelter sections are major contributors in the monthly increase in the headline inflation. Another important point in the inflation data is still the decomposition between service and the good inflation side. So the market is expecting to see some improvement in the service side, but CPI data shows 5.26% of annual increase in the services side. However, improvement in goods side still intact, and there's a minus 2.07% of decrease in goods side. And service price growth still remains stubborn. Here, another inflation indicator, the Supercore inflation that I want to show you. It calculates the service prices without housing costs. It saw monthly and annual increases reaching over like a 5% annually for the first time since April 2023, which was it was around like a 4.46 4 points, yeah, it's around there 4.4%. And here you can see the like when here's the service side, and if you take the shelter out, it's the like the after just after the data, there was a initial selling pressure on the gold, as it is expected to uh, see a rise in the rates. But just after data, due to hedging against risk, like geopolitical risk, because when we received the data, the tensions between Iran and Israel was on, but I mean there was no attack, but yeah, due to the event happened in the earlier this month, the tension was high. So yeah, the supercore inflation is an important economic measurement that uh, separates, like it strips away the volatile items from the traditional CPI, such as food and energy and housing. It's an alternative method for tracking inflation and gives a more accurate snapshot, actually, of underlying price pressure in general, if there's a pressure or not. When people talk about the supercore inflation, they typically mean inflation numbers: less food, less energy, less housing. Uh, but like in general, the energy side and food side are much more prone to volatile price swings. That's why when uh, that's why it's the supercore inflation is important, because so in the housing side, Fed expects a lagged improvement. So then uh, it should be like sensible to take it out to see to evaluate the current improvement that has gone through in the inflation, right? In that case, that's really important. So yeah, while we talked about bond yields, I'll try to explain the factors affecting the bond yields. Bond yields, like first of all, like they play a crucial role in financial markets, as they serve as a uh, barometer for a uh, like economic um, health and investor sentiment. When the bond yields rise, it often indicates expectation of higher inflation and strong economic growth, which leads to also higher borrowing costs for governments and corporations. Conversely, falling bond yields may signal economic uncertainty or a flight to safety. Like central banks closely monitor like bond yields, as they influence monetary policy decisions, such as interest rates. Uh, Additionally, bond yields impact other asset classes, including stocks, currencies, and overall, like they serve as a vital indicator of market conditions, the sentiment shaping the investment strategies, and to understand the financial market behavior. So, what are the factors? Let's first start with the term premium. Uh, it is the amount which like it's the amount of the yield on a long-term bond, like regularly, like the long-term bond yield is greater than the yield on the short-term bond, because like since the US treasuries have like a variety of like bonds in terms of maturities, we can take the differences between the various those various yields to measure the term premium, because it's the premium that investors are asking to be compensated to lock their money, actually. Like the premium, like it's I mean it reflects the amount that amount is the an expected amount by investors for lending for longer periods. And like lower uncertainty means lower term premium and vice versa. So there should be a compensation to buy a 10-year yield rather than 3 month yield in a rolling base, Otherwise, I wouldn't want to lock my fund in the long yield as the uncertainty, because in the long, I mean, if you lock your money, you your fund is much more exposed to potential uncertainties compared to owning a short-term thing. If you have a short-term thing, you'll be like, I mean, for sure you can buy and sell. It's the most liquid market, but the mentality in general, as the uncertainty increase, the compensation is expected to increase. So that's why if we see an increase in the yield curve spread, like also increasing yields, term premium might be one of the reasons to see an increase due to this uncertainty. So inflation expectations, the second factors affecting the bond yields, it's not today's CPI actually. It's more long-term expectation about inflation. As you can see here in this chart, five-year forward inflation expectation rate here, and 10-year break-even and 5-year break-even inflation rate. As it's seen on the chart, there are some like these are the well-known inflation expectation indicators. By the way, it's also employed by the Fed. Like it's their measures. Here, the marked CPI here, the last part. I mean this part, showing the recent spike occurred by the higher than expected, like the CPI data. With the hot CPI data, there's a spike in these inflation expectations as well. And yeah, the third factors affecting the bond yield is growth expectation. We can separate this into first structural growth and second cyclical growth. Structural growth happens when more people enter to workforce, like it represents like it's a good demographics, or when labor and capital are used more effectively, efficiently. In like that, in that scenario, you would expect like, okay, the economy is growing, there's much more efficiency, and there will be more inflation also. These are like those three factors are really like intersectional. Like it's how well an economy can achieve this structural growth plays a crucial role in like determining the long-term bond yields, especially. For example, this recent AI boom, let's say, and it led to big increases in productivity. This is a nice example for structural growth. In that scenario, we would expect to see actually, at the end of it, we would expect to see from current situation, because we have an inverted yield curve right now. If we see with the support of the structural growth and the inflation expectation, we would like to see more increase in the long end of the yield curve compared to short end, in order to reach normalization. Actually, we are at the path of normalization. I'll show in the next slide where are we currently. But yeah, the potential support of AI would be beneficial for this after the fastest expansionary policy themed period, in order to turn back to like a normal yield curve. Structural growth is AI would play a crucial role. And the cyclical growth, the second part of the growth expectations, these are generally shaped by factors like credit cycle, which means monetary policy. Actually, if there is like a ample credits around, like if like there's a low monetary policy, if there are a lot of like credits are given like easily, that might impact the yields. Short ends directly affected by interest rate decisions. And fiscal policies. Another part is like if there is a, for example, stimuluses that was given during the COVID period, fiscal stimuluses, it affects as well. Earnings are also like those are indication of how companies are doing. In that terms, it's also a sign of a growth. And yeah, like how, but to it's actually there are some indicators for tracing growth expectations, and S&P 500 um, earnings per share growth, for example, is a good one to trace how the earnings are doing, and also there's a forecast for it. That's another like indication that you can get some hints how companies are doing, and yeah, those are also effective on the to link the yields movement and current economic environment. Now, I would like to try to examine this, like in general, like yields movement on a chart. Let's see if we can see these factors affecting the yield curve here in this chart. Um, the the top chart is the yield curve difference. It's a yield curve spread, and the bottom one is the real yield chart. What is real yield? This 10-year break-evens means inflation expectations, and 10-year yields. If you subtract 10-year yields, for, the tips is inflation-protected government bonds, which gives always like above yield compared to the current inflation rate. So that's actually a real yields in mentality. How do you calculate real yields? When you subtract 10-year yields from inflation expectations, that gives you the real yields. So yeah, and what while examining yield curve, it's just by looking into 10 years or US 2-year yield does not give like that much insight by their cells. You might get an idea, but I also prefer to check if the yield curve is flattening, if it's steepening. Also, real yields, are they rising? What's the relational situation of real yields with gold and dollar index? Because generally you would expect to see if the real yields are going up. So since the USD is offering real yield, you would expect to see an increase in dollar index, right? Because there's like a safe money, and big funds, especially like pension funds, generally allocates their fund more in secure ways. That's why like this making an intermarket analysis, it's not like a simple just let's check like two charts and okay, let's get an indication. It's not that simple, unfortunately. But yeah, that's why like I would like to examine charts, like yields also in that terms. And so the top chart, the yield curve spread, there are two ways to see an increase in this chart. First of all, if the long end increases more than the short end, as I mentioned before, with the potential structural growth, maybe with the AI support, that might happen. And the second one is if the short end, let's say 3-month yields or two-year yields declines more than the long end of the curve. So mathematically, there are two ways. But like, there's a really important nuance that I want to mention that I didn't mention in the previous slide when I was talking about the term premium. In general, if there is a risky environment, the money goes to treasuries, and naturally, due to its math, the yields come down. Now, currently, you can question that term premium was the sign of the uncertainty. Like, And in case of high uncertainty, we would expect to see an increase in yields. Then why the yields are like coming down in a risky environment uh, where there's a possibility of, let's say, war that might lead to oil price or maybe more. That might be a question. But how I perceive is, I think the term premium math, which like term premium math, in which the investors seek for more compensation to hold long-term treasuries, is just valid under the circumstances where there are like economy-related uncertainties. On the other, like let's say CPI, like inflation, what's going to happen to that? That kind of uncertainty. On the other hand, when there's a potential of a high-risk event, investors remiss from their so-called like luxurious needs of asking like higher compensation and run directly for most liquid and risk-off safe haven assets like US Treasuries. Yeah. So as you can see in this chart, it's an inverted yield curve, and this is the peak of the inversion, and it has been flattening. The chart is flattening since the peak of this inversion. That also means to a path of normalization in the economy, or it's a path of returning to the normals of the yield curve, where the like long-term rates offering higher yields than the shorter ones. Here also, like I would like to mention, just to spot in the chart, this date is 6th of October, the first tension between this like Middle East geopolitical risk issue. With the geopolitical risk, as you see, the yield curve spread steepens and it comes down, right? It means that due to high risk, like a higher than like not economic related risk, investors run to the safe haven. Just after that, with the uncertainty, especially since the Middle East is the center of like oil and stuff, with the support of the uncertainty and potential oil crisis, which might cause to increase the inflation expectations. So I'm referring back to this chart. So this one plus this one lead to increase in yields. Okay. So what are we like? What do we see right now? Here you can see after the CPI data with the inflation expectation. Let me refer back here with this factor. Rates are rising, and we see like a positive impact on flattening path, and little decrease here. This was on Friday, I think, last Friday, and this was caused because like on Friday also like political tension was still there. It comes a bit down, and Saturday the market was closed, but things didn't get too much heated afterwards. That's why with the opening of the week, like still with the uncertainty and with the inflation expectation, considering the recent spikes in the inflation, the uptrend is resumed. Yeah. Okay, I hope you found the information that I gave in this presentation valuable and insightful. If you enjoyed what you saw, please consider to subscribing to our channel and to see more content like this. Your support means a lot, actually, and it helps us to continue creating quality videos. And please, like, don't forget to hit the like button if you found this video helpful, and feel free to share, like, it's with your friends and colleagues who might benefit from it, though. And thank you for watching, and hope to see you in the next one. Have a good one.